Hey everybody, welcome back to Markets for Millennials for the weekly analysis from July the 18th to the 22nd. And right now, what I thought I would do for this week's video is do something that I have not done for a while actually. Just upon reflection, thinking about where the markets are at. I always think it's important when it looks like it's possible that markets could be turning. I'm always looking for the momentum and the inflection points and the indicators to show that these inflection points are being reached. And so going back to kind of this area on the chart, I had started looking at the moving averages, the 50, 100, and 200-day simple moving averages. Kind of in this area, I started looking at them because it looked like, if we just do some review here, as we made our all-time high in January of this year, and we sold off pretty hard, making lower lows not only from mid-December, but late November, and even going back to September. Once we made those lower lows, it was apparent that something was in the works and could be changing. Obviously, back here, we knew that the Fed would be what was finishing their QE program. We also knew that they were telegraphing the raising of rates coming in March, which obviously happened right around this area on the charts. And so I started looking at the long-term moving averages for a sense of the change in momentum. We obviously on this channel we're watching as we made the cross between the 50 and the 100-day moving average, which occurred right here in late February, and then the cross of the 50 to the 200-day moving average, which was in March, right as we were getting ready to bounce. This was our first real big bounce since the sell-off began. We watched as we made a higher high than back in February on this bounce into the end of March. And then we sold off really hard. And since then, other than a small bounce before the May CPI was released, when a lot of people thought that CPI was peaking, a lot of people were expecting the Fed to continue to only hike 50 basis points. We had this kind of melt up here and then some sideways as we waited for CPI. And then obviously since then we came down. And what a lot of people have been talking about has been how in the markets, even though we got a really bad CPI print, worse than normal, or worse than it was even the previous, so we're showing an acceleration of CPI, of consumer price inflation, and the markets didn't make a lower low. We did not break our lows from June 16th or the wick low from June 17th. But rather we retraced in what a lot of people were calling this reversal candle. You can actually see if you look at where my mouse is down towards the bottom right of the screen. And so a lot of people are wondering, is this the bottom? Have we seen the bottom in? And that's really the key question here. That's the topic of this video today is, are we bouncing only, or is this the bottom? And so I think it's appropriate to bring up the moving averages because I want us to see kind of where things are at right now. As you can see, this is probably the greatest distance between the three major moving averages that we've seen in some time on the downside. If we go back on our charts, we didn't even see that big of a gap between them on the March crash, which obviously was very quick, and the Fed stepped in very quickly. By the time the 100-day was crossing the 200-day back then, we were already starting to see the 50-day moving average come up. I mean, we had already retraced more than 50% of price at that point. You have to go back really far. I think probably even having to go back to the bottom of the GFC sell-off for a time when the long-term moving averages were this wide um, at any particular point in time as price was going to the downside. And so I want to put these up here because I think it's important to show the work that the markets still have to do, even when looking at basic moving averages. So as we zoom in on these charts and start trying to pick this apart and really see what's going on here, and where we need to make repairs, um, I think this is going to be a good opportunity to kind of assess where things are at and see if we are at the bottom. In fact, if we have made a bottom, I should say, or if we are just bouncing. Um, and maybe I will start this by saying just off the bat that my bias is that we do have further downside. I really believe that we have at least one more major move down, um, and I think that this is just going to be a bounce. And for all I know, we could have multiple moves to the downside more to go. But that's my base case, is that we have at least one more significant major move down. So here we are on the S&P 500, the E-mini futures, and on a technical basis, let me just talk through some of the positive, some of the negative, and where I think things need to go to show some more promise. First of all, the line in the sand for me is kind of this area right here. I want to see what happens if price can get up into this box, or into this kind of oval I'm drawing, and what happens if price does get up there. And the reason why, if you follow my mouse to the left, you can see this is where we consolidated right before the May CPI was released in June. And that was also where we kind of bottomed before our big March, second half of March bounce this year. So I want to see what happens if price is able to get there. You can also see this yellow moving average. This is the 100-day simple moving average. You can see that that moving average is piercing right into this region. That's going to be a really crucial, important test area for price if we can get up there. So that's kind of the target to watch right now. And if price is able to get there, I will consider that of the utmost importance. I do want to point out, it was a little bit different. Things were happening a little bit differently, but you can actually see back in March, price did pierce the 100-day moving average before rolling over. So just because price might get above it doesn't mean that price is done on the downside. And so I just want to make that clear. Some of the good, as you can see, if you follow the blue 50-day moving average, we were able to clear. I posted about this on Twitter as the markets were coming in close to getting into the 50-day moving average across the major equity indices and also in crypto. We did clear above it, and we've had a couple of candles closing above that level. I think that that's a really important level. You can also see that the 50-day moving average is starting to level off right at about this green horizontal line, which had previously been resistance and had been support. You can kind of see it relates to an area back in February and March of 2021, a general area. Obviously, you have to have some wiggle room when it comes to resistance and support. Sometimes it's not often, even though it can, appear to be as thin as these lines. Sometimes it's much more of an area rather than a thin line. So you can see that those areas are kind of converging, coalescing there. So I do think it's good that we've gotten above there. Some downside, or I should say maybe some negative. Here you can see this dotted trend line. This is a less aggressive line of repair. And you can see that we poked above it just barely in today's trading action, but then actually closed red for the day, closed down. And so the first thing that we need to do now that we've pierced the 50-day moving average, we have to get above this conservative trend line. I would say it's not super strong. This is only really the third, maybe fourth test of this trend line that we've had We didn't get to it back in June, before the CPI print. We didn't quite get back up to that. So I think that that's something, you have to take with a grain of salt. I will be watching to see if we bust through and then get up into our zone, or if it's going to be more of a little breakout or retest resumption. Or the third option would be we consolidate below and then break up above. Um, Often consolidating right below the resistance is a pretty good sign, or can be a pretty good sign if you do get that eventual follow through and breakthrough. Um, but we are still well below the 100 and the 200-day in red moving averages. The While the 50-day is has kind of leveled off, we do definitely still see a pretty low steep angle in the trajectories of these longer term moving averages. The long term momentum is down, and so I think that you have to still start with that bias, until proven otherwise. So on a technical basis, by using the moving averages, that's kind of where I see the S&P right now. I'll kind of give you my base case as to why I think price is going to come off and make another lower low in a little bit. But I just want to take a look through the equity indices on the futures, to kind of give you an idea of where my thoughts are right now. On the Nasdaq, it's basically the same as the S&P, although our price appreciation has come up a bit more sharply than the S&P. We're a bit closer to the 100-day moving average. We've cleared above the 50-day much more convincingly, but we kind of are coming off. Today we obviously closed red. I will be watching to see if we come in for a retest on the 50-day, which you actually see is starting to curl up, while the other moving averages are still definitely pointed down. The NASDAQ has some work to do. I'll show you why. You actually can see this trend line right here, which is connecting the little wicks from December and January, as well as the wicks from March and April. And so we've got this, and this is actually a more conservative line of repair, and I'll show you why. Because technically, let me see if I can get this. Technically, we have this trend line, which is marking these two wicks from our wick top in November. November, what is this, 22nd? And then the other top on December 28th. It's a much more shallow line, but it is obviously like the bigger, in the long term, line that's gonna. There's a lot of space. Like, let's just look. There's a lot of space between these lines, right? But all that is to say, I feel like what'll happen is if we can clear this kind of descending trend line right here, if we can kind of get above it, there's going to be a lot of excitement there, but we still have a lot of work to do. We've got to make it above this trend line, and that's just basics. We also have to be able to get above the 200-day moving average, which would extend out to about right there at that point if price was appreciating. We still have to clear the 100-day moving average as well. So on the Nasdaq, we have a very similar picture as on the S&P. On the Dow, we have it's a little bit more similar to the S&P, because you can see that we got the break above the 50 and the retest before trying to resume up, but then obviously today's sell day. The Dow has been interesting. The Dow was outperforming as it relates to the downside price action up until very recently. I think as price was coming off from the all-time highs, the Dow was not getting hit quite as hard as the S&P and the Nasdaq. The Nasdaq hitting 30% down. Obviously, we'll talk about the Russell in a second, but the Russell was hitting 30% down. But the Dow was much more shallow. And I think what's really interesting is as we start getting into the recession trade, or as people are expecting the recession, what'll be interesting is to see how the Dow reacts during a recession, because it is pretty heavy industrials and cyclicals and things that would get pretty decently hurt in the midst of recession. It doesn't have I mean, it has Apple, but it doesn't have a lot of these other um, mega cap tech companies that typically do well in the midst of recession. Um, uh, especially if a recession triggers and the Fed has to pivot, whether it be through the pausing of rate hikes or having to institute QE again, if that even happens. But you do see a similar structure. The moving averages are all pointing downward, all and the 50-day kind of leveling off from our all-time high. From our all-time high, closing high on the Dow. Currently, we have closed we're about 13% down off the high. So honestly, not that bad. The Dow got down as low as well, the Dow didn't even make it to 20%. So the Dow never hit bear market territory, at least on a technical basis. So I think that that's kind of interesting. The Russell, similar structure. You can actually see what's interesting here is this trend line from our kind of uh, fake breakout back here in November 2021 after if you remember on this channel, we talked about this a lot. We consolidated for the whole year of 2021, essentially from March until November, till we had this kind of prairie dog fake breakout. And then we're connecting from the bounce in at the end of March, the back half of March. And we're actually coming up close to that line. And you can see the 100-day yellow moving average line is lined up almost perfectly with that. It's pretty interesting how that works out. But similar type of structure. So you could see the moving averages are still showing all the markets trending down. The long-term momentum is down. Obviously, it doesn't mean that the market hasn't already bottomed. But there's a couple things I want to look at that go to show that, in my opinion, the markets haven't bottomed. Let's start with the VIX, the volatility index. So I've been watching this for some time on this channel and in my newsletter. I've been pointing out this kind of curling up of the lows, even as we are making lower highs. So it looked like we were kind of getting squeezed into a tighter spot. And I was watching to see if we would make a lower low, and we did. And so that was kind of interesting. And so what I think is kind of interesting to think about is over the last couple of days, as the volatility index, I would say maybe even over the last couple of weeks, as the volatility index has come off, and the equity indices and risk assets in general, especially high beta, have really taken off. Everyone, my base case here is that I think everyone is a little too excited about the markets bouncing here, and I've said this a lot. I mean, let's just pull this back for a second here. Bear markets don't end on with the VIX at this level. Bear markets don't end as the VIX kind of just peters off. I mean, like if you really think about it, if I zoom back in, our wick high was back in January, and Putin hadn't even invaded Ukraine yet. So we had a higher wick spike on the VIX when it wasn't even related to anything geopolitical. It wasn't related to anything rate related because we hadn't started cutting rates until March. It wasn't anything QT related because we didn't start QT until June. I mean, any way that you slice it, it makes no sense that our high in the VIX was in January, like 1 month into the sell-off in equities. And so I think that that's something to be concerned about or to consider. If you look at all the times over the course of the last, what if we want to go even back 13, 14 years to the GFC, every time we had a bear market, you saw the VIX, or anytime we had something close to a bear market, you saw the VIX come up into very elevated territory, and it spikes as you get close to the end of the crisis. So our wick high, like if you just kind of look at where my mouse is at on the right side, our high in the VIX during the March 2020 crash is essentially like the day before, or the day before the markets bottomed. In 2018, at the famous Powell pivot, You basically saw, and also by the way, that was when Donald Trump, president at the time, had tweeted saying it was a good time to buy stocks, and that was the famous Powell pivot when they stopped raising rates. Um, Even as they were trying to tighten financial conditions, obviously that in the long term led to the repo uh, crisis, and then ultimately to the liquidity crisis in 2020. But even at that point, the low of the markets came in right near the wick high in late December. Um, we had a spike in early 2018. I forget what the reasoning was for that. I actually didn't go back and look. Various energy crises where the market bottom took place right around the time of the wick spike in August of 2015. And obviously, I still have these markings up here. If you actually look in 2010, 2011, there are a lot of instances where where the markets were selling off, and these were instances in which the Fed initiated another round of quantitative easing because of where the markets were going. And so in each of these cases, the VIX spikes as you get close to a market bottom. Now, when you look at the VIX in the GFC, and I posted this on Twitter, and I just want to walk through this with you just more clearly here because this will make a little bit more sense. I just want you to pay attention to the structure here of what's going on. So a little bit different because of the timing, but what I did was I marked here, I did this a long time ago, I marked where the market top was, October 9th, 2007, um, and we had already seen a VIX spike. The market started to come off, and anyone who has gone back and looked at the equity indices during that time would have been able to see that the stock market was coming off, something like over 50% by the end of, by the bottom. But I want you to pay real close attention to what was going on with the VIX, because over a period of time, you were making higher lows while at the same time making lower highs. You were getting squeezed into a smaller and smaller area. Not quite as small of an area as what we currently had, but I do think it's important to point out, right? As you move forward, I'm trying not to get the big spike on here too much. You made the lower low, if you follow my mouse, came up, came back down, and then in September of 2008, September 15th, that was the Lehman bankruptcy announced. And while the VIX was elevated that day, the VIX was up 23%, up 600 basis points, up into a high of about 3187, which, by the way, is higher than where we're at right now. Today we closed at 2304. So we had a pretty big VIX candle, but that still wasn't even the end of it. The wick high for the VIX was a couple months later in October. Obviously, there were a whole bunch of different scares going on, but that was obviously a really big moment. And the VIX only started to come off once it became clear that the Fed and other banks were going to act in such a way to lift the markets and to support the markets. Then you saw the VIX start to come off. But the thing I want to really point out, the market bottom hit on March 9th, 2009. The VIX closed, right? So this day, the VIX closed at 49.68. Okay, now I'm not saying that it has to be there, but I am saying that it's interesting that the market bottoms, across these other times that I showed you, the market bottoms typically happened at the spike. And this spike happened long before, or a while before, but the market bottomed with the VIX still almost at 50. And I go through that because I just feel like this bounce with the VIX coming off, right? This bounce is being met with a little bit too much hope, right? A little bit too much excitement. Another contributor to that is the credit spreads, which have really come off over the last little while. Again, While the credit spreads have been elevated, we're nowhere near panic status. Though we did go up higher than the where the Powell pivot was, um, we haven't quite reached panic status like we did obviously in March 2020, back during kind of the energy crisis 2015, 2016, and then obviously the big one um, into the GFC. And what's interesting too is to note that the spike in credit spreads happened, I think, about 2 months after the spike in the VIX, which took place in October of 2008. So I think that that's something to keep in mind. But obviously, credit spreads are coming off, and I think that's an indicator. Um, that I think there's a little bit too much calm and too much, and perhaps even, dare I say, too much excitement about um, the markets bouncing right now. The yield curve is still inverted, consolidating sideways, but closing right around the same level that it closed at, last week when we were in making these really really big lows down. So the yield curve is very very heavily inverted. So obviously the yield curve has never been wrong. The recession is likely to come. So excuse me. I think that those are some reasons why. Now, granted, the markets, they can bounce, they can do whatever they want. Maybe we have bottomed. I'm not saying we have, but it's possible. This would probably be the calmest market bottom I've ever seen. And obviously I haven't been in the markets forever, but just going back through price history, this looks like it would be the calmest market bottom in market history. Uh, dare I say it's not over though. Let's take a look at the dollar, because part of what a lot of people have seen as feeding this rally has been the declining dollar, and really it comes on the heels of the report that the euro or the ECB, I should say, the European Central Bank, was going to raise rates by 50 basis points, which it was a pretty big deal for them. What's really interesting, though, is I think, and that happened a couple of days ago, but I think what's interesting is the market is, for whatever reason, discounting kind of what was discussed at the by Christine Lagarde at the ECB, because, and I'll just really try to briefly explain this. I don't have a graphic to show you to put up, but basically the idea was that even though they're raising rates, they are not. They're reinvesting all of their treasury, all the treasuries that the central bank had been buying. They're reinvesting those things, so it's not like a true roll off. It's not a true taper like they saw, or like we saw in the with the Fed. It's not the same kind of thing. I think the market's discounting that. I also think the market is discounting the fact that they have come up with this new program, which is going to apparently allow them to support, in particular, places like Italy, their yields, or how can I say, supporting Italy at the expense of countries like in Northern Europe, like Germany. So it kind of allows them to treat different areas differently, different countries, I should say, in the European bloc differently, based on the conditions. And so it is, in a sense, I feel like the ECB is talking out both sides of their mouth. On the one hand, they're trying to talk tough, talk about raising rates. They did raise rates. And at the same time, how in any way is this new program going to be beneficial to the euro? And I right now, I feel like the market hasn't really figured that out or understood that. In any case, the dollar had been overbought. And so what I'm going to be watching for is the level for me on the dollar is right now is right about here, which is kind of coming in at a very light support area. This little trend line you can see right here. A much stronger area of support will be right around here, between 104, 105, which is kind of just a general area which the dollar had kind of gotten up into couldn't get above back in April, May, broke up, and then kind of was using and testing as support there. Kind of this general area. Again, with resistance and support, you have to look at it with as areas rather than just as really fine lines. Um, so I'm going to be watching that spot. I'm going to see, you can see I had this kind of wedge pattern forming. We did come down and close below the top part of this wedge. So this is probably invalid, but it is something I'm going to leave up here because I'm just curious about it in the long run. And I've also considered perhaps adjusting it. I'm not really sure. Sometimes you have to be willing to adjust these lines a little bit as the market shows you. So, for example, if price were to come back up tomorrow, or I'm sorry, not tomorrow, next week at the start of the week, then probably what this means is that this line would have to be lowered. It would probably look something like that, which would then show that it was still a valid line. But I'm going to wait for that if that even happens. But the dollar had been overbought. If I show you the dollar on the SAMS indicator, you can actually see that on this breakout, we were touching the upper boundary of the volatility range. And so it's only natural that we are coming off and kind of coming back to a more not neutral in terms of SAMs, even though we are neutral, but coming back to a more neutral position towards the middle. But it is we're still barely favoring the bullish side as far as the location of price in relation to the volatility range. Excuse me. On the 50-day moving average, I do think it's a really important factor to note that price is still well above the 50-day moving average. And you can actually look at where the 50-day moving average is. It's kind of in this range that I was showing you, right? It's kind of like getting into the top part of that range, which is again why I'm looking at that area. If we just pull price history back and you just look at where the 50-day moving average has been an important marker, even when price has come below it, 50-day moving average, 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 almost 50-day moving average, 50-day moving average. So I really think that in this case on the dollar, the 50-day moving average is a pretty good indicator of the momentum. You can only go so far. I mean, everyone's looking for tops. Everyone's been looking for tops in the dollar all the way up. Price could consolidate all the way down to this 50-day moving average, and that would be perfectly normal. It's nothing to call tops on right now. Before I'm willing to call a top on the dollar, we have to come below this dotted trend line, which would mean we would probably be coming below the 50-day moving average in that case. Once that happens, I would be willing to subscribe to the idea that we have a change in trend. But then we still have a lot of space between there and this kind of long-term ascending trend line. If we look at where our lines are, it's a lot of space between there. So that's just something to be aware of. I pulled this up earlier because I like to look at what is happening with the U.S. dollar index, and the dollar was basically down the entire week versus almost everything, only showing a little bit of strength toward the end of the week versus the Canadian dollar, a little bit towards the euro. The yen, interestingly, even as the Bank of Japan has once again committed itself to yield curve control, still for some reason the Japanese yen gained a lot of strength. I find that very interesting considering that because they're doing yield curve control, because the Fed is going to come in most likely with 75 basis points of a hike, but possibly higher. And then on top of all that, excuse me, when equities are coming up, when risk assets, and I know that you see that they're red on the side right now, but when risk assets are coming up, you don't tend to see the Japanese yen being strong. So I think that something is a little bit off here. In fact, I might even be prone to saying that if you're a currency trader, that it might be a good opportunity to take a position against the yen, favoring the US dollar. That would be my guess. I'm not 100% certain. There are a lot of people who are wondering if the US is going to commit to supporting the Bank of Japan and the Japanese society and the Japanese yen. I'm not really sure. I don't have a crystal ball. We'll see. In any case, that's the reason why the DXY has been down over the last week. Yields. I realized I didn't say this on Twitter. I said this on somebody's live stream in a comment, but I just want to point out. I don't even remember how long ago it was. I think when price was somewhere up in this area, I said, "Hey, if price comes off, watch out. A lot of people are going to start calling head and shoulders patterns." And it did not take long on price action over the last couple of days. People have been pointing out essentially this type of trend line. And it really, I mean, it is a head and shoulders basically. I don't know what part of this over here you're going to pick for the shoulder. And if you pick this whole thing for a shoulder, then I don't know how you don't pick this whole thing for a head or something like that. I don't know. I always feel like people are kind of picking head and shoulders too quickly. But in any case, this is a really, really crucial moment. If this is a head and shoulders pattern and it breaks and doesn't bounce here, price is at least going to come down to test this ascending trend line, and more likely is going to I lost my marker. More likely is going to come down and test the other long-term trend line, which you can see is coming in right about here. That's a potentially big drop to be had. It could waterfall down like that. And a lot of people I think are positioning for that. And I think the reason is a lot of people are positioning for recession during a recessionary, deflationary period of time. Bonds are typically a great thing to buy. So I think it's possible that people are beginning to position. I have been saying for some time that I think we get one more good like move up to the upside in bonds, but I might be totally wrong with that. And so you got to just, not try to force the markets to say what you want them to say. You just have to listen to what they're telling you. And right now the market looks like it's telling you that it's about time to buy bonds if you haven't already entered into that position. So I'm going to be waiting to see what's going on here. I want to take a quick look. I know we've been recording for a long time, but take a quick look at gold. Gold has had a couple of good days to end the week. I think ending green. Yeah, look, ending green on the week, ending up about 1.18%. What was really interesting, let me go to a 1 hour chart so I can show you. On the morning of the ECB announcement, that was yesterday morning, we got this enormous, 21, almost $22 candle in 1 hour to the upside. And that's been kind of the reversal. So this whole time, one of the things I've been observing is, if gold is typically what somebody would buy as an inflationary hedge, kind of a hedge against, insanity and craziness in the world for geopolitical crisis and whatnot. It's been very interesting watching gold be so depressing coming off like this. And granted, gold was super oversold. It was due for a bounce. But I do think it's interesting. It coincided with the ECB news. So I'm wondering, are we going to see the trend change now in gold? It got down to right near its 2021 lows, which you see back here. Just not good on gold overall. Just looks ugly still. Still got a lot of damage to repair, and to start, at the very least, we got to get above this descending trend line. If we get back up here and we get rejected again, I think we're going to break the 2021 lows. So it'll be something to watch. Crude oil, really interesting stuff on crude oil. It looked like we were going to break out from this trend line. We got rejected and we came back down. It really looks like it wants to go down further. I've been talking about this on my newsletter. The SAMS indicator is bearish. Hasn't been bearish for this long in a while, but obviously those, you can kind of see what happened with those. Um, we're still holding our lows from when the war premium between Russia and Ukraine wore off. But obviously, it really does look like crude oil wants to come back off. And I think that, again, people are really discounting oil because of the impending recession. I think people are assuming demand destruction. But I also think that people aren't paying attention to supply, including comments by Saudi Arabia over the last week, where they not only basically told Biden, like, no, we're not doing what you want us to do. Um, we won't be able to increase production until 2027 by just 1 million barrels. And some people are questioning whether that's even going to be possible. Um, Things don't look good from a supply standpoint, so I think that this is really interesting. And I guess we're really going to see what wins in this type of market. Are we going to see oil come back up because we're so constrained in terms of supply and development and research and things like that, or is the lack of demand, is demand going to be an issue? Are we going to have demand destruction? Is this going to come off? We're basically out of room. So either we're going to break this trend line. If we do break this trend line, I think it's going to go right back up towards 110, 115, 120. And if we break down, then I would say the first support is going to be around $85. So that's going to be something I'm watching for. And then a quick look at Bitcoin. People watching Bitcoin thinking that it has bottomed. And the basic premise here that I would go with is, if you think stocks are going to go down, if you think in general risk assets are going to go further down, then you probably have to also think that Bitcoin and crypto are going to go down at least one more time. Some really good bullish things happening though. Some different things I was watching. Let me just put everything up, and then I'll kind of color over it as you watch. So I was watching a few things. I was watching something like this kind of little wedge triangle. We broke out of it and have come in for a retest, and we're getting close to resuming off. So if you want to look at that formation, that looks pretty bullish. I was watching this flag kind of formation. I think some people were watching that too, which we did break above, but also kind of broke down below again. So I'm not sure if that's totally bullish or not. What'll be interesting is to see if we can get back up, if we can get above that level. So that's not quite as bullish. We broke above this line of repair right here, which has gone back all the way to our bounce into the end of March and beginning of April. Got above that. That's a bullish sign. If we look at our 50-day moving average, we have closed above it. We broke through, closed above it, and we're still holding above it. Even yesterday, we closed barely above that candle. And so again, we're looking for a resumption off, making a higher high. So that is looking a little bit more bullish. So there are, I mean, if you only looked at this part of the chart right here, then you would get the sense that this is a super bullish asset getting ready to take off. Of course, then you pull back and you look at this and you're like, oh, maybe not. Bringing up the other major moving averages, all pointed down. So the long-term momentum is down. Again, not to say that Bitcoin can't break through this, and that, I mean, this bounce could be really big. I mean, if you think about our previous bounce, we kind of consolidated sideways, bounced up. If you go from the bottom to the top right before we rolled back over, that was almost 36%. And so if you go from, let's see, let me see here. Yeah, okay. So then if you go from our closing bottom up here and you go to about 35%, that brings us up to about a little over 26,000. So we could totally bounce higher. A lot of people bringing up this move from when we bottomed in July of 2021, and we ended up going over 100% in a matter of months. And so I mean, if we made 100% move off the bottom, if we go just off the closing bottom, 100% move brings us up to about 38,500. Again, totally possible without actually breaking the structure of lower highs overall on swing trading time frame. So in any case, Bitcoin we've got some bullish price action happening, but the overall trend is down and still bearish. And again, particularly as it relates to crypto, with the amount of stable coins still available for on the sidelines for people to buy the dip, and the general excitement that I'm seeing on the interwebs for price action, price behavior, it's hard for me right now to see us as having bottomed on Bitcoin. And if I just show you some of my premium newsletter subscribers know about this, but my MRT tool for Bitcoin, when you look at that, price has always at least touched the orange line. It did not touch yet, and so my assumption would be, as after we've come down, that we're going to bounce and then we're going to come right back down and make contact, probably cross, but at least make contact with that line before we actually bottom. And so that's my base case, but obviously I am flexible and ready for the market to prove me wrong. And I am positioned so that I can capitalize if I'm right, and but not positioned in such a way that I will be super harmed if I'm wrong. So you have to learn how to smartly position yourself based on the probabilities that you see in front of you, and so that's what I've done. Hope you had a great week. Hopefully you guys have a great weekend. I'll see you guys next time.